Good afternoon, everyone. I'm Indradeep Ghosh, Executive Director of Dvara Research. I lead and oversee all of the different research efforts that are ongoing at Dvara, and I will be your host for the webinar today. Our presenter today is Amulya Neelam. Amulya is a research assistant associate working with the Financial Systems Design Initiative at Dvara Research. She has worked in the past on research questions of suitability of financial services and products and what that means for the conduct of financial service providers. She has also worked on a similar paper. She's going to present today on payments banks, but she has also worked on a similar paper for small finance banks and has asked what progress small finance banks have made towards financial inclusion. And in her current work, she is looking at how the RBI's credit monitoring and credit supervision protocols could be upgraded so that the RBI is able to detect and prevent over indebtedness among low income households. Amulya holds a postgraduate diploma in rural management from the Institute of Rural Management in Anand. So today, Amulya will be presenting a research paper on whether payments banks are beginning to serve the goal of financial inclusion that they were set up to do. As some of you may know, payments banks is a new category of banking institution that was first proposed by the Committee on Comprehensive Financial Services for Low-Income Households in 2013. And in 2015, several banks received licenses to operate in this new form. It is still early days yet, and much of the data we are beginning to receive about payments banks operations is still not quite there in terms of allowing us to conclusively establish whether payments banks are fulfilling their promise of financial inclusion. Still, Amulya's presentation will highlight the indicators that would be meaningful to look at and what these indicators show with the limited data that is available. I should also add that Dvara Research was the research secretariat for that committee that recommended payments banks, and therefore Dvara Research was closely involved in all of the work that culminated in the proposal to the RBI for introducing this new category of banks. Despite this antecedent, we have made a sincere attempt in this work to remain unbiased and to look at the evidence objectively in order to answer the question at hand. Our contribution is not only the assessment of payments banks, but more importantly, the framework for assessment, that is the indicators we believe can shed light on whether payments banks are beginning to demonstrate success towards financial inclusion or not. We welcome comments, suggestions, and criticism. So I will now turn it over to Amulya.
Thank you, Indradeep. Thank you, everybody, for joining for today's session. I'll just get started on the presentation. Okay, so the title of my presentation today is Have Payments Banks Fulfilled Their Financial Inclusion Promise? And the structure of today's presentation is as follows. First, I'll talk a little bit about payments banks, how the model was envisioned versus how it has been implemented, and then also give a brief description on what has been our approach to analysis for the work that we've undertaken. And then I'll also talk about some major findings that we have had on the performance of payments banks, and then a little bit about the competitive landscape that payments banks have seen and the evolution of it since their conception, and then about the challenges the payments bank model and individual payments banks also have faced, and then finally end with the major ideas that we've found from our work and the scope of further research. Okay, so to start off with, payments banks were established by the Reserve Bank of India, RBI, in 2014 when the licensing guidelines were released by the RBI. This was also when the licensing guidelines where small finance banks were introduced. So payments banks are the first truly differentiated type of bank in India. And this is so because the banking functions undertaken by payment banks are of only two, that is the payments and deposits, and they do not do credit function. And as mentioned by Indradeep, the payments bank model was conceptualized in the RBI committee of this committee, Comprehensive Financial Services for Small Businesses and Low-Income Households, which was chaired by Dr. Nachiket Moore. And as part of this report, the payments bank model was put forward as a form of a vertically differentiated banking system design. So the differentiated banking system design is a framework which was set forth in the report in an attempt to understand what is the banking system design in the country, and to also see what potential future institutional designs that we can look at. So as you can see here, there are two broad categories, broad designs within the banking system design. The first is the horizontal and the vertical. The horizontal, which you see on the left, is the horizontally differentiated banking system design. In this case, the horizontally differentiated banking systems, these banks can perform all the banking functions of payments, deposits, and credit. So in a sense that their operations are similar to a full service bank. The only differentiation is along these metrics of size, geography, sectoral focus, whether or not they use agents and access capital markets, etc. And the other broad design is that of the vertically differentiated banking system. In this case, you have the banks which perform one or more of the banking functions that you see here, payments, deposits, or credit. So as for this framework, we see that the payments bank fits under the VDBS, the vertically differentiated banking system, in that it performs the functions of payments and deposits. So this was the framework as was laid out in the CCFS report, the Moore committee report. However, this is quite different from quite different. This is sort of different from the articulation which RBI does. So as per RBI's definition of differentiation, so they see a differentiated bank as one that is different from a universal bank in on account of these metrics, that if they have a different capital requirement or scope of activities or even area of operations, so these can be considered reasons for the bank to be differentiated. So as per RBI's definition of differentiated banks, local area banks, urban cooperative banks, regional rural banks, all of these can be considered as differentiated banks. What we must note point to is that even though these banks, UCBs, RRBs, and LABs, do have some sort of regional or sectoral focus, but they're not really a horizontally differentiated banking system, because they have additional regulatory prescriptions that are placed on them, which make their functioning different from a full service bank. Um, similar in the case of small finance bank, that too is considered by RBI as a differentiated bank because it provides all the banking functions. But we say that is not the case, because they have regulatory prescriptions such as the size or lending requirements, such as a greater percentage needs to go towards PSL. So which makes it different from a full service bank, and hence cannot be truly called a differentiated bank. So as per the framework that we've presented here, it's only the payment banks in the country right now which can be called a differentiated bank. Okay, so now I'll talk about some of the features that RBI has put forth in as part of the payments bank model. So what you see here is the objective as stated by the RBI, that payments bank need to further financial inclusion by providing a small savings account and payments or remittance services to migrant labor workforce, low-income households, small businesses, or other unorganized sector entities and other users, by enabling high volume, low value transactions in deposits or payments in a secure technology driven environment. Okay, so now so what I've here is a few regulatory features of payments banks. These are not all of them, but these are just some of the important ones which set them apart from a universal or a full service bank. So what you see first here is within the scope of activities, they can do a lot of functions related to deposits and payments, but one of the key aspects is that their deposit balances. So payments banks can give current accounts and savings account, but the deposit balance is capped at rupees 1 lakh. And another of the feature is about the deployment of their funds. That is, they're required to have minimum of 75% of their deposit balances in SLR, that is in government securities or treasury bills. Also, their capital requirement is different from that of universal banks or even small finance banks, and that their paid up equity is lower of rupees 100 crore, and capital adequacy ratio is higher. That is, it's set at 15% of their total risk-weighted assets. So that was it about some features of payments banks. So what I have here is just a timeline of events that have happened. So in 2015, as you see, 11 entities received the in principle approval, and in 16 we see that Airtel has begun operations, and 3 other entities have certain licenses. And through the years, other payments bank have begun operations, but Geo and NSGL are still in pilot operations as of March this year. And we also see in 19, a couple of other entities have surrendered their licenses. So is it just for a timeline to show how it has been since RBI put forward the idea. So coming to the approach to our analysis. So we see the value of payments bank. The value of payments bank is seen to come from them being able to use their large networks to provide cash in and cash out services. And this was seen as a differentiator from prepaid instruments, PPIs like wallets and prepaid cards, which also have a similar functionality that they can provide deposits and facilitate payments. And our work here we have focused on seeing whether payments banks have progressed on financial inclusion goals by specifically looking at questions like whether there has been a proliferation of transaction touch points enabled by payments banks. So these touch points need not just be of that of bank branches, but also of any other physical access points like BC points. And we've also looked at the question of whether there has been a difference in the nature of transactions. For example, the extent of whether it's a physical or a digital transaction enabled by payments banks versus those of full service banks. So within this study, we've looked at the 4 fully operational payments banks as of March 2020, as I told you. These are Airtel Payments Banks, India Post Payments Banks, Fino Payments Bank, and Paytm Payments Banks. And these are the data resources that we've used. So that's the RBI with its notifications and circular, and the database of Indian economy, DBI, which puts out all the data points. MCS master data for financial statements of the companies, and the payment banks and their parent companies annual reports and websites and news reports where they were relevant or available. So now I'll just move on to the findings that we've had. The first is just on the number of touch points. Okay, so to start off with, so how we've defined touch points is to include all of the physical access points available that can enable the provision of payments banking services. So these would not just be a brick and mortar branch, but also anything else like a BC point or even unmanned points like ATMs or even POS terminals, etc. So what we have here is the like a graph of the total number of touch points of these 4 payments banks. And we see that they have a large network of over 13 lakh touch points. And each of these payments banks like bring in a different flavor to their touch points. So for example, we have Airtel here, which has the highest number of touch points. So the Airtel's large number of touch points is because of its parent company's retail network. And it's a similar case in the case of India Post Payments Bank, which also has its branches co-located in the premises of India Post office. So you see that that's why there's a large number of touch points, and as we'll see later on, the geographic spread is also quite high. Fino 2, in its earlier form, its parent company used to provide corporate BC services, so it has some familiarity with the operations and a good retail network, and it also has interesting partnerships such as those it had with Bharat Petroleum, BPCL, and also with the state government of Rajasthan. And Paytm 2 has, even though slightly lower than the other, because it has a large digital presence, it still has distinctive touch points like the KYC points, which you may all know of, where you have their agent sitting into just to do the KYC operations. They also have designated points called the Paytm ka ATM, through which they provide payment banking services. So that was about the number, and now we'll look at what is the nature of the touch points, right? So the general expectation from PBs was that they utilize their large retail network. So even in the RBI's licensing guidelines, it invited applicants from entities such as NBFC, supermarkets, mobile telephone companies, real sector cooperatives, etc. So basically, all of these entities which have a large retail network. So the expectation was always that they would use a large physical network to do their operations, and that would be their differentiating factor. And what we have here is just a quick table of so we have so what I have here is like 3 payments banks and 1 small finance bank and three other banks. And to just to check a ratio of what is the number of branches and the number of PC points to see what is the composition of their touch points. So touch points being all the physical access points as I talked about earlier. So what we see from the very high ratio of the payments banks, especially of Paytm banks, which has uh, quite a low number of branches, we see that the PB touch points have a significantly larger proportion, which are agents and of non-branch in nature as compared to small finance banks and also universal banks. Okay, so coming to the branch spread. Um, okay, so one thing before I get into detail about this is, as mentioned earlier, branch is not a significant part of the payments bank's touch points, but we do not have data on the non-branch, especially the geography and the distribution of the agent touch points. So what we do have is on branch spread on branch touch points, and we shall look at that. But we must keep in mind that because most of the points of PVs are of agents, this is not indicative of the total. So, so we see that among branches, there are 765 branches of the 4 payments banks, and most of them are belong to India Post Payments Bank, which form 85% of the total. So the first graph that you see here is a region-wide spread of payments bank branches. So these are the geographic regions of Central, Eastern, Western, etc. Um, so on the green line that I have here corresponds to the right-hand axis, and thus the India Post Payments Bank. I had to pull it out separately because it has such high numbers. So as you can see, it's really only the India Post Payments Bank which has a considerable spread across the regions. And this is so because India Post Payments Bank has one branch in each district of the country. And I suppose their model is to have a hub and spoke, that they have a branch and then they have a branch in each district, and you have the other BC agents performing operations in a spoke manner, which is why they have large numbers and also great distribution. But otherwise, the other payments banks are sort of not very well distributed. So on the right hand side, you see is the population group wise distribution. So this is just to classify locations as rural, semi-urban, urban, or metropolitan, just based on their population. Again, if you see here, it's okay. So while India Post Payments Banks is a bit concentrated to the semi-urban and urban in distribution within itself, but in looking at absolute numbers, we see it's really the IPPB which has greater numbers in the rural, many times in fact compared to the other ones. So that was it about branch spread. And now I'll give you some quick points on what we found about ATMs and POS. So ATMs and POS is also an important point to look at because these also form part of the physical access points, especially in the case of payments banks, which do not rely as much on branches. Okay, so what we have on the right here is the numbers, just the numbers on the own ATMs and the POS terminals which were acquired by the payments bank. So we see that as of March 2020, it was only Fino and Paytm which had numbers. And so the number of Paytm POS terminals are actually quite on the higher side, and that is more than even mid-sized banks such as PNB and IndusInd. So just something about IPPB. IPPB does not have any POS terminals. Instead, it chooses to employ a strategy of using QR cards. I mean, customers are given QR cards. And the transaction is done through biometric-enabled smart devices. so essentially micro ATMs. And I don't think this has started yet, but the plan for retail transactions is to also place like a merchant retail card at shops so that transactions can go through. Yeah, so that other than POS terminals, most PBs, Airtel especially does not, Airtel especially employs Aadhaar-enabled payment system micro ATMs instead of just plain POS terminals. So these are the biometric scanner. And Airtel Payments Bank actually additionally has a system, is a cardless system of, it's a cash transfer as well as a cash withdrawal called the instant money transfer. In this case, in those set of ATMs which have the option of IMT, you need not need a card. You can just use your mobile and an OTP to withdraw cash or even send it to a beneficiary. So that was that for the numbers of and how ATMs and POS have been used. So now I'll be talking about how, if there has been any presence of the payments bank in unbanked areas. Okay, so RBI has a branch authorization policy as per which uh, every bank is required, including payments bank, is required to open 25% of their banking outlets in unbanked rural areas, unbanked rural centers called URCs. So rural centers are essentially, it's a cutoff based on population. Rural is all those less than 10,000. And unbanked are those rural centers which do not have access to a core banking system, a CBS enabled banking outlet. And interestingly, so this is for all new banking outlets that are opened. 1/4 of them are required to be opened in URCs. Okay, so interestingly, these guidelines were changed in 2017 from branch to banking outlet. So earlier it used to be based on branch, that is 1/4 of all the branches that you're opening in a period are to be in unbanked rural center in a URC. But then this was changed to a banking outlet, which has a more expansive definition and it's more inclusive. And this change was seen necessary, especially with the changes that have happened in the banking landscape with the introduction of payments banks and small finance banks. The expectation was that these new type of banks would use technology to have a different outreach method or a different method of delivery, and which would not be branches. So if you were really looking to use a branch authorization policy for the purpose of financial inclusion, you would want uh, uh, access points to go to those places which do not have any access points like banking outlets instead of just branches, right? And so that was a major change that was made. So what I have here is just a quick figure on to explain what is the universe of touch points. On the left-hand side, you see these are those which are designated as banking outlets. On the right hand are the non-banking outlets, but these are also access points. So our the branch authorization policy is now applicable to what you see on the left, which is the banking outlets. Another change that was implemented in these guidelines in 2017 was that there is also an allowance to calculate part-time functioning of a branch. Earlier, it was just each physical branch was counted as one in the denominator when you're calculating how much need to be. But in this case, you can on a pro rata basis calculate part-time banking outlets as well. So if you function half of the time, you're counted as 0.5 of a banking outlet. Okay, so just some numbers on what are unbanked centers and how many of these we think payments banks have made entry into. So in 2015, there was an estimate on from one of RBI's internal working groups that the number of centers without brick and mortar branches was 5.5 lakh. So we should understand that brick and mortar branches is um, would be that this number would be obviously less than the number of banking outlets, which would include other aspects like BC, fixed point BC delivery, etc. But still, these numbers are for brick and mortar those areas without brick and mortar branches are 5.5 lakh in number, and 99.7% of these are in the rural areas. And the corresponding population of these unbanked centers, as I should refer to them in this sentence only, so the corresponding population was 96% of the total population, and that's a significant number, right? Which do not have an access to a brick and mortar branch. And so we've seen earlier that the payments banks have a network of 13 lakh touch points, and assuming full compliance to the RBI's guidelines, we could say that there have been an additional 3 lakh payments touch points being set up in these unbanked rural centers. And because this definition has been changed to banking outlets, we know that these 3 lakh are in areas which do not even have BCs operating, right? And just to give you an idea about the numbers, so in the graph here you see, the brown line is just the PB touch points as of estimated now, and that is in the current year. But the green line is of BC, the number of BC points in villages, and villages only, and how it's over the years. And we see that the PBs in the short duration of functioning have brought out these almost more than half of the number of the total BC touch points. And if they're assuming there is compliance, it could be a significant increase in the provision of services to the unbanked areas, which was created by the payments banks. Okay, so next I'll talk about the transactions that were enabled by the payments banks. Okay, as I mentioned earlier, providing payments and remittance services is one of the key objectives of payments banks. And so these transactions can be of both, the physical and digital nature. So what we look at first is just the physical touch points. So what you see here in the top two charts are just the number of transactions that were done using the debit cards issued by payments banks at any POS or any ATM. And you can see that there's been a greater usage at the POS terminals, right? So that gives us some hint into what are the kind of transactions that are enabled by the payments bank, that it's the physical transactions to a large extent of the payments bank are at the POS terminal or at the retail facing, but have a lower transactional value. And if you see below, it's just a comparison of the average value, which is of both the payments banks and a couple of other banks. The point here is just that they have a lower average value. Yeah, and again, there is another comparison of the POS transactions of payments banks with that of SFBs. Here too, both the volume and value of the transactions enabled by payments banks is greater than that of small finance banks. So one thing to be noted here is, okay, we see that a lot of the transactions are possibly being done at the retail and they're of a lower value, but it still does not give us any idea as to whether payments banks have enabled these transactions to those underserved or unserved areas, or whether they've been done to those particular categories that we looked at in the objective earlier, right? Like migrant workers, etc. So we still don't know that. That information is not available, but this is what we have. Another about the digital transactions. So in case of digital transactions, we've seen that payments banks have serviced large volumes of transactions, especially in the case of mobile transactions. And even within mobile transactions, there is particularly Paytm Payments Bank, which enabled a huge number and amount of mobile transactions, close to more than most of even the full service banks. And interestingly enough, there was also high volumes of RTGS transactions, even though they have higher limits. This could mean that there has been some strategy on part of the payments bank to onboarding business or current accounts or any of the high value transacting customers. So the graph that we see here is essentially of the average mobile transaction value. And these are the top 20 banks which have had the highest value of mobile transactions. Right. So we see that Paytm and Airtel have figured in the highest value. So which means they're doing high value transactions. But if you look at them, they have pretty much like a lower average value. So even though they're, in a sense that, yeah, again, like I said, so we can see that the average value of the transaction is lower, but we do not know where is it coming from. It could just be a function of their business model and not that any indication towards progress of financial inclusion, etc. Okay, so I've talked about touch points and the nature of touch points and the nature and volumes of the transactions as well. So now I'll move to talking about what has been the competitive landscape of payments banks, and specifically start looking at deposits. So we know that payments bank deposits act as a store of funds through which, which you can easily access and through which transactions can be facilitated. And these can also act as small savings accounts for the underserved, right? But what you see is the interest rates on payments bank deposits are lower than that of small finance banks, and definitely lower than that of scheduled commercial banks. And I mean, it's because the model is not favorable to provide interest earning savings account. That's because 75% of their deposit balances are required to be invested in risk free, but still low return um, instruments. So this constrains the payments banks from even providing a higher um, rate of interest. So in terms of interest rate, if you look at only interest rate as a metric of choosing a savings account, you see that payments bank account does not look like an attractive option, but they could still possess some advantage in terms of access, that even though they're not providing the best interest rates, they could still be the ones, especially in unbanked rural centers, they could still be the only ones or one of the very few ones providing access to savings account and also cash and cash out services. So another quick metric that we've done here is something like a velocity of deposits to see how deposits, to what use deposits have been used in payments banks and comparison to small finance banks and all other scheduled commercial banks, right? So if you see in the table here, so we have the deposit balance. So I've taken the deposit balance of only the current accounts and savings account and disregarded the term deposits so as to make them comparable to payments banks. And so that was that for deposit. In terms of transactions taken, the value of ATM transactions, POS transactions, and mobile transactions. So these are the only three, and I'm taking them as a proxy of the total transactions. It's not the universe of total transactions, but there is no clear availability of such data. So I'm just taking this as a close proxy to the total number of transactions. So now what we've done here to calculate the velocity of deposit is to calculate the ratio of the transaction value. So this is for a period of a year actually, ending at March 2020. So in that year, what has been the average of the deposits, the starting and the ending deposit, and the total value of transactions that happened in that particular year. And if you see the ratio, you see that the ratio is quite high for payments banks, much more than small finance banks and scheduled commercial banks, right? So this high ratio shows that these accounts, the payments banks accounts, are being used mostly for transaction purposes and not for transactions, payments, remittances, and not as a place for savings or to keep your deposits. Okay, so that was a competitive landscape with respect to deposits. Now I'll move to the landscape specifically with respect to prepaid instruments, and which is one of the significant parts. So as I mentioned earlier, prepaid instruments are functionally equivalent to the payments bank's accounts in that they act as a small savings account or a deposit and through which you can do transactions. And an additional incentive that payment bank accounts can provide is that they can give interest to their savings accounts, which and also provide cash in cash out services, and which well, at least in the earlier stage, PPIs could not do. About the interest rate, it's on the flip side, actually, it's a factor of cost for the payments banks that they do have to provide interest to the deposits. Um, so the Moore Committee recommendation, so Moore Committee is where the payments bank model was proposed. So the recommendation in that report was that with the advent of payments bank model, existing PPI licenses should convert to either should apply to become either a payment bank or should convert to doing BC operations, and that no new license set should be issued. And so this was a recommendation which was made in the report, and this has not materialized, and which is partly also why it's the current landscape in terms of competition is quite heated for payments banks and quite different from how it was originally envisioned. So now I'll just talk about how just PPI transactions have taken place. So what we see here is a graph with the volume of PPI transactions, and we see that there's been an increasing use of PPIs for the purpose of transactions, especially after demonetization. Even though the growth rate has kind of lowered, the share of PPI volumes to the retail payments is still high, and it's growing year on year. And uh, so all of this I'm talking in the point of view of competition to payments bank, and non-payment bank PPI issuers have huge volumes of transactions, 3 times that of payments banks. But the question still remains that yes, non-payments bank, the other PPIs are enabling huge volumes of transactions. The question still remains is, are they being used or in the rural areas, or are they enabling transactions for the underserved, unserved, etc.? And the question of them not being able to fully provide cash in cash out services is still not in their favor, not in the PPI's favor. Okay, so here I'm going to talk about how the regulatory space of PPIs has changed, and because of which there's been PPIs have posed a greater competition to the payments banks. The first is there has been a change in regulations to allow PPIs to move from a limited version to a one with higher limits. So the limited version, basically it had a lower uh, balance outstanding, lower number of reloading amount, etc. And this limited version could operate with no KYC. So that is, it just needed customer details and OTP verification from the mobile, and that was it. But PPIs were forced to implement a minimum KYC or a full KYC. It's now full KYC. So a full KYC compliant PPI has now an increased transaction limit and an outstanding balance. Its outstanding balance is at rupees 1 lakh, and which is as much as that of a payments bank account. So these changes have kind of brought the PPIs or the wallets and the functionality and their features closer to that of the payments bank accounts. So this was the regulatory change that have happened. Another is that, so this is the next one is not in favor of the PPIs, that earlier they were allowed to use Aadhaar for KYC, and that was rescinded sometime in between, and that they could no longer use Aadhaar for KYC and they had to do manual KYC, and the existing all fresh KYC had to be done manually, and so did the existing ones. And this was later modified to just allow banks to do. So in a sense that payments banks have some ground of advantage that they can use Aadhaar for KYC, but these couldn't. Another regulatory change. The third regulatory change, the most important one, is UPI-related flexibilities that were introduced. Right. The first is being allowed interoperability for PPI wallets. So earlier wallets could not transact with each other, but now after interoperability using UPI was introduced, you could make one could make transactions from one wallet to another via UPI. This again put PPIs very close to payments bank accounts. And another change that was recently introduced in March this year was the option of having limited cash out facility at merchant locations through PPI. Again, this is through UPI. So PPI providers can allow the user to withdraw up to rupees 2,000 in case of the rural tiers it has a cap on the number of transactions, and this can be done at the merchant location, but it still is a big change to the disadvantage of payments banks, whose earlier advantage was that they would provide SECO services, but now you see that even PPIs can provide SECO services to some extent. Right. So what we've seen here, so these changes, such as increasing of the outstanding balance, interoperability, allowing some little form of cash out, all of these brought the fully KYC compliant PPI accounts almost at par with those of payment bank accounts. But payment banks still hold some advantage, significant advantage, especially in terms of the SECO services, because even though it is allowed for the PPIs to some extent, it's still a small number, and payments bank can still utilize their large existing retail network to gain an upper hand. So now I'll move to the challenges that were faced by the payments bank, and first is in the form of violations in institutional conduct and lack of regulatory clarity. So we've seen that in the past, both the Paytm Payments Bank and Airtel Payments Bank have faced bans on opening customer accounts and significant penalties over issues of non-conformity to KYC norms. And mostly that they were opening customer accounts without informed consent. And so these kind of significantly malign the image of payments bank. But what one must note is these violations are not peculiar to PBs, that they do happen in case of other banks as well. But because payment banks themselves use a large agent network, it reflects significantly higher on the payments banks. But yeah, so there is still some there's still some scope for work on how this issues of informed consent and who should supervise the agents, right? Whether it be for payments banks or regular banks, should and the issue of delegated supervision should be left to the bank, etc. Are still some issues that need to be taken up. And Paytm, and there were other, again, frauds and concerns, especially with regards to Paytm's cybersecurity fraud. And Fino too faced some action from RBI due to violations on operating guidelines, that they had their customer balances go up upwards of rupees 1 lakh. So these were a few raps that several payments banks received from RBI from the time of their conception till now. So these were violations in institutional conduct. Other than that, there is a point on the lack of regulatory clarity, especially in case of BCs undertaking KYC on behalf of RBI regulated entities. So it's not clear if an agent were to do KYC, are these can the agent completely do KYC, or does it finally need to be verified by a bank, is still a gray area in terms of regulation, and the clarification of which would be better for payments banks. All banks would be better for all banks, more for payments banks because they operate on a huge agent network. So the second set of challenges that the payments banks have faced was about profitability concerns, right? So from the time of their conception, there's been significant public discussion on just the profitability of the model itself. And there have also been, there have been several entities which have surrendered the license, two of them citing profitability concern and about how they don't think they could survive. But what must be noted here is that, so these are new banks which are being set up, and because they're so focused on transactions, they need to set up all these infrastructure for transactions, all of which would have significant expenditure, especially in the early years. So we see that so the PBs have their operational expenditure as at 95%, which is significantly high compared to 23% for full service banks. So that is a downer on their profitability, but it's only the beginning. And we've also seen news reports of Fino Payments Bank claiming operational profitability. This is before taxes and depreciation, and Paytm Payments Bank claiming net profitability. Again, So it does seem like an indication that yes, payments banks can scale and be profitable, but I should just mention that these have not been verified by us because they're not available to the public. The audited financial statements are not available. So, but it can still be taken as a positive sign. Generally, for the payment bank itself, for long-term viability, it needs to pursue adjacent revenue sources, not just of transactions and deposits, but others using the platform model by looking at things like data monetization, provisioning of third-party services, charging merchants, etc. So that would be one way in which it can be financially sustainable by adopting a platform model. The platform model itself needs a scale to succeed, to be financially sustainable. So that was it for challenges. Just as a conclusion. Um, so as we've seen earlier in the challenges, payments banks have had to face rapidly evolving and uncertain regulatory landscape, especially in terms of the changes that have been made to prepaid instruments and unforeseen challenges again about conduct violations and also profitability concerns. We've also seen that payments banks have established and created a large number of touch points and in the country, and most of these are of the non-branch type. They've also facilitated high volumes of digital transactions, but the point is we still cannot conclude whether these have been inclusive enough, especially in the hard to service areas. Right? We do not know whether payments banks have gone to these areas to enable new transactions. Again, one point that we've also seen is that payments bank accounts were mostly used for the purpose of payments and not as much for savings, which was actually one of the key objectives as put forward by RBI. But yeah, which is also fine. Having a transaction account is still goes a long way in payments inclusion or financial inclusion. But due to the lack of data, the question still remains that yes, there have been a large number of transactions, but where have these transactions come from? What category of people are they serving? So that's why I conclude by putting forward that there could be a scope for further research, that we try to understand what are the qualitative aspects of transactions, adoption of the different kinds of banks by payments banks or prepaid instruments or full service banks, and how is this different amongst each type and specific to the area, whether it be unbanked, unbanked, or or certain demographic types or occupations like migrant workers, etc. Another question for further research is to see if there are any ways to model the network effects of such an adoption in these areas or for these demographics. And also another is that how can last mile touch points be held to good standards of institutional conduct, because we've seen several violations, and if we do want agent banking to go a long way, we do need to have better standards. So yeah, so that's it for my presentation. I'll wait here for any questions that anybody may have.
Right. So thank you, Amulya, for that presentation. Um, so we do have a question. I'm not sure how I activate. Um, so we have one person who has raised his hand.
So anybody who has questions can put it in the Q&A box that you see in the
Yeah,
bar.
please, if you could just put your question in the Q&A box, then that we can take it up from there. I do know, Amulya, and for our other guests who are attending, we have some guests from Nigeria today on this call. Nigeria has introduced payments banks in their own country, basically following the example of India. And so our guests from Nigeria are also here and hoping to learn from our own learnings about payments banks. So we welcome questions from them as well. If I may ask people who have questions to kindly enter their questions into the Q&A box. We don't have the facility to actually give you the floor to ask your question. Okay, yes. So there is a question about micro lending by payments banks, microfinance or lending impact of payments banks versus scheduled commercial banks. Amulya,
Okay.
do you want to take that up?
Yes. So, so like I said earlier, payments banks, because they are a differentiated bank, they can directly do only deposits and payments functions. But as BCs, they can be BCs to other scheduled commercial banks and can provide lending through the BC function. But that is not something that we have studied, because that data is not available to us. But we do know anecdotally that payments banks like Fino and Airtel, etc., have been doing micro lending, having tied up with NBFCs and other banks to do so. Yeah, so we do not have numbers or in terms of impact or changes, but we do know that it's a great area for them to take up, especially because of their network and the kind of data and information that they do have on the customers. They can be a great value addition to the space of micro lending, but sorry, we do not have any information.
So Amulya, I will also add to that just another perspective, which is that, payments banks are not themselves allowed to lend, because
Yes.
that the model prevents them from originating any credit themselves. So what they can, however, do is become conduits for credit products from other banks and other financial institutions. Uh, so where I think where the payments bank business model comes into play in this kind of arrangement is the promise of data that the payments bank is going to collect over time on its customers. Presumably these customers are going to use their payments bank accounts to make payments and to transact, and that transactions data can become an important source of information for the payments bank to assess things like credit worthiness or credit risk for its customers. So the model here is is not the traditional model of microfinance lending, because payments banks are explicitly forbidden to lend themselves, but rather this kind of uh, model where because of the scale that payments banks are able to achieve by signing on more and more customers, and because of the nature of their interactions with the payments bank, the payments bank ends up sitting on a vast treasure trove of information that can then be used not just to sell credit products, but to sell all kinds of other products and services to the customers. I don't think that we are there yet, right? Because I think that it will take some time for payments banks to build up that customer base. And also a certain amount of time will have to elapse before this data becomes of a sufficiently big scale that it can be mined for those kinds of insights. So we also have a question which is asking whether, again, I would say that, Amulya, you can also take this on, which is a question about the insurance sector and its impact on profitability, if you can elaborate. I think the answer is somewhat similar, no? That payments banks can become conduits through which insurance products can be sold to payments banks customers, and that could become an engine of revenue for payments banks. But for that to start happening, first payments banks will have to build up that customer base. And then there is a question about ATM and POS, being profitable to payments banks like Airtel and Paytm. Amulya, you want to take that up?
Yeah. Um, okay, so in case of traditional POS terminals, these are actually do have a significant cost associated to them, especially for payments banks which have a greater number of agents, right? So if you were to give POS terminals for all of these agents, it would be significantly expensive. Um, because depending on what the functionalities that you have, the price may vary per terminal from rupees 7,000 to upwards to 20,000, right? Um, so I don't know specifically about how just using POS terminals and ATMs has impacted the profitability, but I can say this for sure that uh, in several cases like Airtel, which has chosen to use micro ATMs, and also India Post Payments Banks, which has chose to do micro ATMs. So micro ATMs, I suppose, can be of less cost because all you need is a device which can do a biometric, and that's enough for a transaction to go through. So
Amulya,
that
there
was
is a
about.
question from Denise.
Okay.
Sorry, did you finish?
Yeah, I finished with that.
So there is a question from Denise who is asking why a banking category is needed for an institution that does not do lending and therefore does not do any banking business. Is there any recommendation or consideration by the RBI to have a non-bank category that can collect funds and focus on transactions such as e-money?
Right. So as I had made clear the differences, so essentially a non-bank e-money provider, the equivalent would be the prepaid instruments in the form of wallets or prepaid cards. And the one issue is about them being able to provide cash out services, right? So one of the concerns I would say is about money laundering concerns, that in case of greater amounts when you're withdrawing, these anti-money laundering requirements are not placed on non-banks, but they are off banks. So it wouldn't be ideal to have non-banks do significant cash withdrawal services. So that is one justification or reason why for a payments or for a banking license for the payments banks. So on the yeah, I hope that answered your question. Because the non-bank category equivalent to that would be the PPI, which can take in money and also be used to do transactions, but not so much of cash withdrawal. Oh, and sorry, just one more point. In case of the payments bank's accounts, the deposits in the payments bank's account have a greater security because of them being banks. They are members of the DICGC, and they do get insurance on the deposits. So that is one additional benefit to the small depositors towards whom payments bank is targeted. So which is why a banking license would help.
Okay. So there are one or two other questions. Denise, I think, has made a comment rather than a question, which is that not being allowed to provide cash out is a big issue. There's a question about whether payments banks in the current framework or in the current setting, whether payments banks are really ending up competing with traditional banks who have much greater brand presence, branch presence, etc. Would that be a fair assessment, though, of payments banks?
So, in fact, I would not see them as competing because there's just additional infrastructure, right? The banks can use them as VCs to provide services where they did not earlier see it, viable to go. In fact, I would say that the payments banks network is also could be beneficial to the traditional banks themselves to service areas where they earlier did not go to because it wasn't profitable for them. So I don't see it as a competing. I think it's could be mutually beneficial to both. That payments bank act as BCs and traditional banks get BCs.
Okay, good. So I think we'll end the webinar there. Thank you all for attending. We have published this research brief on our website and blog, so please feel free to read the full report. Obviously, there's a lot more detail in that report. And do feel free to write to us at Dvara if you have comments, suggestions, questions. And we will continue to track how payments banks are performing. It is still, like I said at the very beginning, early days yet. As more data comes in, as payments banks begin to build more presence, we will continue to look at revisit this question of whether they are actually meaningfully including or not. So thank you, everyone. Thank you, Amulya. And we will
Thank you,
close the
everybody.
webinar.